Let's take a look at the market activity now for today. And for that, I'm joined by Burgess, Portfolio Manager from Nedbank Private Wealth. Always good to have you with us, Carl.
Good to see you.
Likewise. While we're wrapping up the month of September, was it one to remember?
I think there was a lot of volatility in the month of September, but if you have to break it down sector by sector, probably not very memorable, because there was pretty much red across the board. And if you have a look at that in comparison to the currencies, so the rand pound losing about 7% there, rand dollar about 4%, and the euro about 4%. So you'd expect that to have come through to the rand hedges and to at least prop the all share index up a little bit, but seeing a bit of divergence there. So we'll probably end off September on the all share index down by about 2%, and the currencies would have lost probably, I'd say, on average about 5%. So that's quite interesting to note. But yeah, a lot of company results being reported, and certainly a lot on the political front, especially regarding Donald Trump or President Donald Trump and what's happening in North Korea. So glad that one's behind us.
Let's talk about Trump a little bit more. If he's not tweeting, it's the threats about missiles going off or him firing people within the White House. But what have we seen with regard to the dynamics, and of course how that continues to add a lot of pressure on the equity space? I think we also saw some of the tech stocks also pulling back slightly this week.
Yeah, so I think if you if you have a look at the rhetoric around Donald Trump and what's happening with North Korea and the threat of nuclear war, that investors seem to have taken their eyes a little bit off that at the moment. I think the tension is certainly still there, but their eyes are a little bit off that at the moment. And we've seen the UN Security Council imposing additional sanctions, and while China has largely backed North Korea, they've been very good in implementing their sanctions. So last night, I believe that they were given 120 days. North Koreans and North Korean companies operating in China were given 120 days to basically close up shop. So that's quite interesting. Obviously, Chinese shops in North Korea or operations in North Korea seem to be exempt from that, but certainly is talks to the fact that they are tightening up around those sanctions, which is great. And then if you look sort of closer to the US economy, I mean, Donald Trump 11 months ago was running on the fact that 15% corporate tax rates were something that was quite achievable. So there's been a lot of talk around that. Investors watching the latest sort of attack on, or not attack, but change in legislature after sort of repeal and replacing Obamacare. So I think that we probably won't see 15% in terms of a corporate tax cut, but probably closer to 20-25%, which is well below the 35%. And I think if you have a look at that, your biggest benefactors are probably going to be energy stocks, which are the highest. So they're paying probably about an average of about 38%.
Sure.
While tech stocks are funnily enough have been they seem to be quite astute at sort of avoiding paying taxes. So their average tax rate's about 23%, as far as I understand it. So, however, if you have to go back to the beginning of the year and base investments around that, so you'd have probably been going short tech stocks and long energy counters. It probably it wouldn't have worked out very well for you.
Yeah.
So certainly a lot at play. And I think a lot of guys watching what's going to happen around tax reform now.
Well, interesting times, no doubt, when it comes to Trump and some of the policies he looks to implement. If we come closer to home, though, what are the dynamics with what we see with some of our local retailers? Holdsport, one of those that also gave us an update just yesterday.
Yeah, so they pretty solid update, and I think they continue to deliver really good results year after year, and certainly I think it's mandatory now for CEOs of retailers to say that it's a tough economic environment.
Exactly.
But delivering growth around 8%. They haven't declared a dividend. They usually declare a full and an interim dividend. They haven't declared that until they basically conclude the long for life, until that deal sort of concluded. So there'll be a vote on the 3rd of October around that acquisition by long for life of the entire share capital of Holdsport. So Brian Joffe, I'm sure, is very busy at the moment battening down that deal.
With that said, though, if we do take a look at the valuations of retailers, they've certainly re-rated since the beginning of the year, where they were a lot firmer. But are there particular sweet spots that remain resilient?
Yeah, it's a difficult one, because I think if you look at it in terms of a pretty flat market, I like the fact that they are cash generative businesses and they pay you nice dividends. So just wrapping, I suppose, up the year, if you look at it, we're up 8.5%. The dividends from the likes of Truist and Fushini's, they're paying between 5 and 6% dividend yield. So you don't need much capital growth from those sort of counters to get a pretty decent return on them. That being said, in a pretty slow economy, it is a difficult story to sell, I think, but I quite like them to, just because of the sort of dividends that they are paying.
Massmart also one of those. The share price weak about 1.3% today, and of course, as we heard in the headlines, apparently some strike action at one of its operations. So again, interesting conversations, I guess.
Being trapped in a mass market store.
Exactly. And the wage negotiations adding more pressure, and of course we know how that deal initially took place with Walmart coming into South Africa.
Yeah, absolutely. But I think just going back to the sort of violent protests, I don't think that it's something new to us as South Africans. There always seems to be quite a lot of protests for various different reasons. So it seems to be a sort of a common thread on our screens at the moment.
Exactly. If we also take a look at the banking environment, of course, news that there's a new banking entrant into South Africa, more using digital platforms just yesterday, which is supported by Burgess African Rainbow Capital. I nearly said minerals, then I realized, it's the other one. And of course, seeing a slight pickup in the financials stocks this time around. What do you make of the changing landscape, given that Capitec also had results this week?
So I think it's going to be very interesting to see, because Time, as you know, they're serving sort of the lower segment of the market, and certainly the smaller or small to medium enterprises. And from the digital space, I think it's very interesting. And as far as I understand, they've got quite a few kiosks in Pick and Pay and the Boxer stores. So it's going to be very interesting to see how those kiosks, how they actually look firstly, and how they operate. So I think it's an exciting space. Particularly now that you've got Discovery, with the launch of their bank, which is fairly imminent. This is an area that not that I don't think that Discovery will be operating in the same area as Capitec, but from a broader banking perspective, certainly a lot more competition. Maybe that just speaks to the opportunities that are in that market at the moment. Certainly from a South African perspective, but maybe a broader African perspective as well.
Carl, before we do wrap up, of course, it's been an interesting last 9 months of the year, and we headed into the last 3 months of the year, and trading activity must be kind of interesting. And I'm assuming that from your clients, you get a lot more questions regarding the volatility globally. Is it still a good time to actually expose and give yourself more exposure offshore? But given what we're seeing regarding the global and local dynamics, what trending or investment expectations should we have if we have to realign our objectives at all?
So I think it's a good time to really batten down the hatches. We've got a lot going on politically, locally in South Africa, with December approaching, a lot happening, both in Europe and the US. So I certainly think it's a time to batten down the hatches, because, there's been so much volatility in the currencies that, I think that you probably should have been positioned in terms of your rand hedges in your portfolio by now. There certainly has been a lot of opportunity, with the rand, well below 13 to the dollar for most of the year, I think. So there's certainly been times that you could have added those stocks to your portfolio, but I think probably it's be the more prudent approach to kind of wait and hold and see what the rest of the year brings.
Yeah. One more question on Choppies. Their results not looking too impressive. Some say maybe like a pigsty.
Yeah. Yeah. So they came to the market. I think the share price traded for quite some time well above 5 rand a share, but that's come down heavily. I think last year trading around 2.50 if I'm not mistaken. So not a fantastic set of results, and I think that just speaks to the retail environment. So you really have to be a sharp operator, I think, to really be profitable in this environment.
Well, tough times ahead, no doubt, but consumers, as we know, we continue to spend regardless.
Unfortunately.
Yeah. We'll leave it there for today, Carl. Always a pleasure having you with us. That was Carl Burgess, Portfolio Manager at Nedbank Private Wealth, giving us an update on the local and global market dynamics. After the break, though, it's been 4 years since Uber first launched in Africa, and coming up, we'll speak to the Uber General Manager for Sub-Saharan Africa, Alon Litz, to give us more insight into how this 4-year journey has been.